Let's get right to it with Nvidia. Now, Nvidia, we're a day away from expiration, so what we wanted to do is go to the April 25th expiration and then sell the April 11th expiration, buying the 105 call, looking at the expected move between now and April 11th, which is about $7, $7.50, and we sold the 113 call, so about an $8 call diagonal in Nvidia, buying at the money and then selling next week's, not this week's, next week's, in line with the expected move. So we put that in around $4.50. It's trading about $4.60 now. It's moved up about a dime. Remember, the risk on a call diagonal is the debit paid. You're looking for a move towards that short strike. Like I said, the expected move for next week is about $7.50. Stock's trading a little over 105, so right in line, 113 with the expected move. If you want to be a little more aggressive, could move that strike down to 112, but in this case, it's the 105, 113 call diagonal, and the risk on the trade is the debit paid.
Some of the most cutting-edge graphics processing units, GPUs, for data centers are supplied by Nvidia. These pieces of hardware are used by developers to power and train artificial intelligence AI software. The company's market valuation has increased by more than $2.3 trillion since the beginning of 2023, which may be explained by the fact that demand for its chips is significantly higher than what it can now offer. Last month, CEO Jensen Huang presented some amazing catalysts at Nvidia's annual GPU Technology Conference, GTC, that might quicken the company's already explosive growth. This could be a big purchasing opportunity because its stock is currently down 27% from its record high due to the market's severe sell-off. Every artificial intelligence application is built on top of large language models, or LLMs. Mountains of data are used to train these models, and the more data an LLM has access to, the smarter the tool that is produced. Nvidia's data center GPUs are in high demand since training them necessitates enormous quantities of processing power, especially parallel processing capability. Until recently, LLMs provided one-shot responses, which meant that for each prompt input from the user, a chatbot would quickly provide a single result. Although this approach was quick and efficient, it was unable to eliminate errors, which reduced its usefulness and user experience. Now, leading developers like DeepSeek, Anthropic, and OpenAI are concentrating on a completely different strategy known as test-time scaling, or reasoning. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Chip makers managed to escape specific tariffs in President Trump's new levies on imports to the U.S., but those stocks still got slammed today, along with the broader market. Joining me now is Gil Luria, D.A. Davidson Managing Director. Gil, always good to see you. So I'm looking, Gil, here at the SMH, the ETF that tracks the chips. It's down about 9% in today's trade, Gil, so it gets slammed. How are you thinking, Gil, about what these Trump tariffs do mean broadly for the chips, at least near to intermediate term? How are you thinking through it?
Yeah, there's several levels of impact. What we already know, there's going to be broad 10% tariffs on everything. So I think saying that there's going to be 10% price increases across the board or cost increases across the board is fair. Not a coincidence that stocks were down that much. But then there's the next level effect. So the next one is the reason semiconductors were excluded from the reciprocal tariffs wasn't that we're not going to tax them. It was that there's going to be specific regime for regulating and tariff around semiconductors that we don't know about yet. So we will learn about it. It is very likely to include China and restrictions on China. So we will find out about those, and those will probably make it even worse. And then the next order effect is what an overall slowdown in the economy is going to do to demand. Let's not forget that when Microsoft, Google, Amazon, and Meta embarked on this journey to do this huge build out of data centers, their core businesses were doing very well and generating a tremendous amount of cash. And they were willing to make this speculative bet that AI is going to generate fantastic returns in the next several years. If the global economy weakens, demand weakens, their core products have less cash to produce, they're less likely to want to be on an aggressive path towards building data centers that are only going to pay off many years in the future. And that is going to have an impact on the semiconductor space as well. So I think those are the levels of thinking that we need to have right now as we find out what's next.
So the data center side, Gil, but then are you also saying, just to make sure I'm understanding you right, that we also have to be concerned about all the products that chips go into on the consumer side too, smartphones, PCs, autos, because they are getting tariffs. So as those prices get up, we have to be watchful for demand destruction there?
Yeah, absolutely. So there's the 10% across the board tariffs, but when we're importing iPhones from China, the tariffs on those are going to be far higher, or any consumer electronics that we're importing from anywhere, which often does come from China. Those tariffs are going to be very significant and make put the manufacturers and the brands in a tough spot of either absorbing the tariffs or raising prices very substantially, which will have one way or another have a dampening effect on demand.
Do you think, Gil, we're talking kind of near to intermediate term effects here. Long term, do you think all this could result in what Trump really wants here, which is this ramp, this increase in domestic chip manufacturing?
Well, you just reported TSMC going to build more in here, going to partner with Intel to do it. That is what the administration wants. And this is something that's been in the work for a few years. But these are very long-term investments. These are investments that pay off over decades. And the administration needed to make it clear to these companies that this is the new regime and they need to start making more of their product in the United States. We're doing it for a variety of reasons. Many of them have to do with our national interest. And the administration had to make it clear this isn't going to change. And if you want to sell your semiconductor products in the United States, you need to make them in the United States. And that's why it's not a coincidence that we got that announcement today. And TSMC has been aggressively building out its capacity in the U.S. They're uniquely qualified to make these chips. It is very hard to do so. And the administration wants them to do that in the U.S.
I got to ask you, Gil, while I have you about NVIDIA, because I know you've been on the sidelines there. I'm looking at this chart, though, Gil. I mean, this stock has now been shelled. It's down almost 25% year to date. I'm curious, given that move, how does valuation look now, Gil, for NVIDIA?
Well, if you asked me a couple of days ago, I would have told you that it looks pretty balanced because the upside was pretty substantial. If you believe consensus estimates for next year and you put a historical multiple on that, the stock could go to 160. If you don't, if you think that CapEx is going to roll over this year and this is peak year, then and you put a lower end multiple on that, the stock could go to 80. And so as of a couple of days ago, that was a pretty balanced risk reward. But based on everything we just talked about, if I'm Microsoft, if I'm Google, if I'm Amazon, if I'm Meta, and I'm looking at my core product getting weaker, investors already being concerned at the rate I'm investing or over investing in CapEx, I would think that we need to revisit that CapEx outlook that just a few weeks ago looked set to be up 40, 50% over last year. I would think that as we hear from these companies, we're going to hear increasing caution about whether or not they're going to deploy all the data centers at the rates that they were previously planning to do.
These models take more time thinking before responding to inputs, as opposed to just consuming an infinite amount of data. In other words, they utilize their existing data more effectively and are more likely to correct any errors in the process before publishing the finished product. This strategy has been extremely effective, yielding some of the most sophisticated AI models to date, including Alphabet's Gemini 2.5 Pro, DeepSeek's R1, OpenAI's GPT-4o series, and Anthropic's Claude 3.7 Sonnet. On the other hand, reasoning models demand a lot more processing power. Huang claims that because of the amount of thinking that occurs in the background, each response uses 10 times as many tokens. As a result, the models also generate final outputs far more slowly. Huang predicts that developers will soon require an astounding 100 times more processing capacity to deploy reasoning models with a satisfying user experience, and that GPUs will need to be 10 times faster to make up for this. One step in that way is the new Blackwell GPU architecture from Nvidia. In certain setups, a Blackwell GB200 GPU can execute AI inference 30 times quicker than the company's Hopper-based processors from its prior generation. Additionally, Nvidia unveiled its new Blackwell Ultra architecture last month, which is specifically made for reasoning models and can give 50 times higher performance than Hopper. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Some of your thoughts here, because a lot of folks had targets at the end of the year that were looking much higher than current levels. How are you feeling now? I think you were in the higher end, maybe above 6,500 or so. Tell me a little bit about where your targets may be now for the year end.
Well, Nicole, they're certainly coming down, and I think everything that has transpired is just something that you're not able to foresee, especially the level of tariffs that were announced yesterday. I think surprised everyone, as we're seeing with the market activity today. But coming into the year, one of the things that we were warning about was just how high sentiment was. And we thought that could continue to run high, but with the tariffs announcement, it really just puts a wrench in things because it was running so high. Any little bit of bad news had the ability to derail valuations, which were so high. And that's exactly what we have seen. So we actually think now you're going to continue to see valuations derate further from here. What was announced yesterday is going to be a big hit to economic growth. That picture is darkening. So we would not be surprised if you see another 5 to 10% hit in valuations from where we're at today, just given how high the starting point was.
Understood. When you look at tech stocks that have been beaten down, are you starting to say, I'm seeing some opportunities?
Not quite yet. And I think for a couple reasons. One, if you look at just what pockets of the market are getting hit the hardest right now, it's those areas where valuations have run up significantly, and tech is obviously leading the pack there. So that's one reason. I think the other challenging piece here is what these tariffs are doing is they're really just freezing corporate spending. They're freezing investment activity. So a lot of that CapEx that would really benefit a lot of those tech stocks, we think you're going to see a pullback on that. So I don't think we're outright in territory right now where a lot of these names are a buy rating. Even just look at the Mag 7 right now. I mean, we're still trading at 26 times earnings or so. We're not cheap, and that is to do with the fact that we were starting at such an extreme point. So I think there will come a time, but we don't think this bottom is in right now. Uncertainty is going to be the name of the game. It has been over the last 2 months. And that's really not going anywhere anytime soon.
Nvidia's GPU sales may benefit greatly from the ongoing trend toward reasoning models. Huang stated at GTC last month that the top 4 cloud infrastructure service providers, and consequently the biggest data center operators globally, had already acquired an astounding 3.6 million Blackwell GPUs, nearly tripling the quantity of Hopper chips they bought the previous year. These 4 cloud service providers are Oracle Cloud Infrastructure, Google Cloud, Microsoft Azure, and Amazon Web Services. The total number of Blackwell orders is most likely much greater because that list excludes additional high spenders who are creating AI for their own uses, such as Tesla, OpenAI, and Meta platforms. This may only be the beginning, as Huang projects that by 2028, expenditure on AI infrastructure would surpass $1 trillion yearly, with a large portion of that amount going into AI accelerator chips like those offered by Nvidia. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Kevin Green joins us, our senior markets correspondent. My MicroStrategy puts are feeling good, but the rest of my portfolio is hurting KG. I wish I would have listened to you yesterday. What was it, a Head and Shoulders you dug up under a rock?
Yeah, well, yeah, that was on the 5-minute chart, on the intraday chart. And obviously, it held up into the equity close, but then it broke. And once again, going below that key level that we had. I mean, these numbers are starting to get a little insane when we're looking at it, but obviously we saw a flush and it continued to happen even today. If you're kind of looking at it on an intraday basis, this is a very big key area for us to be able to hold here. Now, saying that down 4.6% probably doesn't mean a lot, but it will actually either create a little bit more of a flush to the downside here if we break this 5,400 level, moving down to 5,375. But if not, if we're able to hold, maybe we do get a little bit of a relief going into the equity close here, Oliver. But there has been just aggressive selling, and this is one of these days. It's a really good example of how the markets can actually react here. We had this flush to the downside, and we saw some buying pressure happening at around 5,420. That was a level, a small level here that actually did react, and we did see a nice little push to the upside. But obviously, we had this, indecision candle, doji. We had a hanging man candle. We had a huge flush to the downside here. Tried to double bottom, and then we just had a false breakout signal and then broke to the downside. And that's kind of where we're at near those lows here today. Could it get a little bit more uglier going into the close? I would say it actually could, because we still have advancing stocks compared to NYSE advanced declining stocks. If you look at the net here, when we started the drop, that drop was actually based on a lot of the larger cap or mega cap names. And we actually saw advancing stocks kind of continuing to rise to the upside. You now saw a little bit of a break of that correlation, and now that's starting to come down and go lower. But if you look at that chart,
ADD was lagging basically.
Right. But if you were at the lows of, when we got to 5420 earlier today, you saw that advanced, that ADD line, if you will, right? Pretty much kind of hit those lows. We're not even near that yet. So could we get more selling pressure? It could. It's probably not going to be a mega cap names. It'll be everything else under the hood here. But 5,400 is a pretty decent level when you're looking at positioning here. Let's see if it's going to be able to hold.
5420, the point there that we found some support. So I guess maybe if you're going for like a quick scalp, that's possible the upside to go revisit that. Is there any hope to firm before the close, KG, or you think people are just going to dump?
I don't know. I think that there's probably more of a risk of either pen to the 5,400 or more of a move to the downside, honestly. It just kind of depends. Okay. There could be a risk covering type of trade that does take place. Yeah, you could rocket higher. I would caution, though, if you're going to do these swings, you got to trade directly. If you're trading SPY, if you're trading E-mini S&P futures, the options, because we're so kind of close to the close here, Oliver, the pricing, especially if you're looking at futures options, but even SPX, the pricing is not going to give you probably that much movement unless we get a massive move to the upside, like a 30-point move. It would be a little bit dangerous here to try to play with time value going into the close. And that's from somebody that does trade options into the close all the time. Yeah. Today, you're seeing a lot of slack. You're seeing a lot of slack right now. You're not seeing the deltas, the Greeks. I don't want to say they don't mean anything, but you got to discount it a lot more here because these market makers are trying to defend themselves a little bit more.
I got a lot of bodies on the field in that last 30 minutes of trading for me. KG, the gamma stuff, let's talk about it, though, because that's kind of how this segment originated itself, that word that a lot of folks like to look at. And I'm curious on the charts. One of the things we've been talking about with volatility is that VIX didn't get to the March highs. It didn't get to the December highs. Something that you and I talked about this morning, Danny Kirsch also pointing it out. Is there any connection to the market maker exposure on the gamma side that there's some wall we haven't broken yet? And if it does, that's when you do get like another fresh VIX breakout. Is there anything in there?
Yeah, so there are some levels to the downside to be mindful of. So I know the previous segment you guys talked about, I believe 5,000, around that 5,000 level. That is actually going to be key. There has been a straddle position that has been in place for, I've been following it for the last 3 years. Somebody continues to roll it, both put and call straddle there, where there's a significant amount of positioning. And then over the last, I would say 3 weeks or so, somebody has been buying the 4650 puts pretty much every single day. Way out of the money, but they're probably actually making a little bit of money on them because obviously the move to the downside here, they're probably getting some of that gamma exposure to the downside. But if you're looking between now or where we're at right now, 5,500 was kind of that key level, and you're just going to continue to kind of ramp down from here. I would say 5,000 is actually really the next big area of focus for these markets. If we are able to get down to those levels there, that would be your major fracture in this market.
If then that's a far ways away, it kind of closed me out with a thought about how to, or maybe not, I guess it depends on how you define.
I'm just playing with you. Yeah.
Then do you, if it's not that far, then should we be owning volatility if that's going to break?
Yeah,
if it's so close to breaking, should we own vol then, even at 30?
Yeah, that's a problem that you have, though. A vol at 30, you can go long vol right now, but there's a reason why it's at 30. And I don't know what that reason is. There's a reason why it's not really ramping up. And the concern that you have is, yes, markets can continue to go down. Vol can continue to creep higher. But usually if you're a vol trader, you don't like vol creeping higher. You like vol spiking, and then it kind of reverses lower. Yeah. So it makes it a little bit more of a harder trade. I think you kind of talked about some put spreads in the previous segment. That's probably the better route to go rather than just going straight long vol, especially if you're looking at VIX options. Right now, they're going to be completely blown out. And even trying to do VIX spreads right now, because they're European settled, you're not going to get any real premium on them. If you're trying to sell credit spreads, you're not going to really get any good debit there. You're going to be paying a hefty premium. At the money you're probably paying right now, and I'm just assuming you're probably going to pay a 70 delta, 75 delta for at the money put spreads and VIX, which is not great. And that's because you don't have the exercise feature with them. So if you want to be able to own vol, I would probably own vol more in the, if you're looking at SPX, SPY, Qs. You could also look at owning vol in small caps. Actually, the small cap vol is probably the juicier play right now, just because it's already in correction territory if you're looking at the Russell. Yes, that would probably be the main play.
6.5%. Hey, could you, last point, I hope that this is not the technical read. A lot of folks say you can't do technical analysis on the VIX because it's mean reverting, whatever, fine, but just for giggles, if this chart has this, resistance level on VIX basically at 30, boy, I hope that this has not been a creep build up for a breakout, man, because then that looks really ugly.
It does. Look, can VIX go higher from here? I would say yes. Usually, Oliver, and this
usually
is
bet against it. Yep.
Right.
That's exactly what we said in March.
Now you sell vol. Here's the reason why. Vol can come down and we could still be at around 5,000 or the 5,400 level, right? Mm-hmm. Volatility needs something to feed on itself. Yes. We need a catalyst, and it's got to be more than just price. You're going to need to have a news catalyst. Now, if you think that there's going to be more bad news coming on in the picture here over the next 24, 48 hours, 2 months, 3 months, yeah, own vol. But this kind of gets you to the scenario where you have to debate if you want to really sell vol or really want to own vol right now. I probably look at those other ancillary areas. Russell Premium is probably the
preferred
bigger
playground?
Beta play.
Okay.
Yeah, it's probably the bigger beta play when it comes to volatility right now.
It sounds like if you want to express, though, a positive view, it's probably vol fading rather than owning equity, I guess, which might be a riskier bet. But we'll see.
Revenue from Nvidia's data center division reached $115.2 billion in fiscal 2025, which concluded on January 26th. That was a 142% increase over the previous year. The company's sales probably have a lot of opportunity to grow if Huang's prediction comes true. Investors now have the chance to purchase Nvidia stock at a competitive price compared to its historical peak, thanks to the company's 27% decline from its most recent peak. At the moment, its price-to-earnings PE ratio stands at 36.9. In addition to being its lowest level in 3 years, it is 38% below its 10-year average PE ratio of 59.5. Furthermore, Nvidia's earnings per share, EPS, for fiscal 2026 are expected to reach $4.53, according to Wall Street consensus projections. This results in a projected PE ratio of only 23.9 for the stock. In other words, if Wall Street's projection of EPS turns out to be correct, Nvidia would need to increase by 149% by the end of this fiscal year simply to trade in line with its 10-year average PE ratio of 59.5. Having said that, if Huang is right, the largest profits for Nvidia stockholders may occur over the next 3 to 5 years. Therefore, I believe investors should look beyond the next 12 months.